Okay, so forget that image, right? The Wall Street wizard, the finance PhD.
Yeah, the super genius crunching numbers.
Exactly. Today, we're diving into something, well, way more fundamental for your financial success.
Mm-hmm.
Something that, maybe surprisingly, isn't really about being a math whiz.
Mm-hmm. We're talking about the psychology of money.
Because when it comes down to it, how you behave with money, that seems to be the real game changer, not just, your IQ.
That's absolutely right. So our mission here is to kind of unpack these hidden emotional, psychological forces that are really driving our financial choices.
Yeah, pull back the curtain a bit.
We've got some really interesting ideas that show why sometimes we do things with our money that, well, they just don't seem logical on the surface.
Okay.
So yeah, let's maybe set aside the hot stock tips for a minute
Right.
and focus on these like fundamental mental shifts, the things that can actually change your financial life.
All right, I like it. So first, big idea. No one's crazy,
Mm-hmm.
but everyone's biased. That's a fascinating starting point.
It really is.
The idea that behavior that looks totally irrational to me or to you
Mm.
might make perfect sense if you actually understood where that person was coming from, their background.
Exactly. I mean, think about it. Someone who, say, grew up experiencing hyperinflation,
Okay.
they might completely distrust banks, right?
Yeah.
They might prefer holding physical cash, maybe gold, under the mattress.
Which sounds kind of paranoid if you haven't lived through that.
Right. To someone who's only ever known stable prices and reliable banks, that seems odd, maybe even crazy. But their lived experience, that history, it's totally shaped their financial worldview.
So the key insight is financial irrationality is often just deeply personal rationality.
That's a great way to put it. It's rational based on their unique story, their experiences.
So instead of judging someone's money choices,
Yeah, shaking their heads.
the real value is trying to understand the story behind them. Like, what were their early money lessons? What unconscious stuff are they running on?
And it makes you think about your own programming, doesn't it?
Totally. What hidden scripts am I running about money?
Exactly. What are those beliefs maybe learned from parents or society or specific events that we've just absorbed over time, maybe without even realizing it?
Uh-huh.
Recognizing those biases, that's got to be the first step, right? Towards making choices that are more, I don't know, thoughtful, less just reacting emotionally.
Okay, that makes a lot of sense. Now, what about this idea of compounding? The eighth wonder. Sounds kind of fancy.
It does, but the secret sauce isn't some complex formula. It's actually much simpler. It's just time.
Time. Okay.
Yeah, look at Warren Buffett. It's pretty mind-blowing, but something like 99% of his huge fortune was made after his 50th birthday.
99%.
After 50, wow, right.
Now, obviously, he's a brilliant investor, no doubt about that.
Yeah.
But the bedrock, the foundation of that incredible success is the sheer number of decades he let his investments just sit there and grow.
And grow.
So it wasn't just about picking the absolute best stocks every single year.
No, I mean, that helped, obviously. But the real magic was time in the market, not trying to perfectly time the market, just staying invested.
There's a powerful illustration there, isn't there? Like, imagine if Buffett had started later, say at 30, and then decided to retire at 60, like many people do.
Yeah, he'd still be rich, for sure. Comfortable.
But nowhere near the icon he is today. His skill might be the same, but he would miss those critical decades of compounding where things really start to take off exponentially.
That's it, exactly. So the takeaway is maybe focus less on chasing incredibly high returns, which often involves taking huge risks,
Mm-hmm.
and more on achieving good, solid, long returns, staying in the game for the long haul.
Consistency over intensity, maybe?
Yeah, I like that. The most powerful way to build wealth isn't necessarily the fastest way. It's about consistency, staying invested, and letting that compounding power just do its thing over many, many years.
Okay, so building wealth needs that time, that consistency. But then there's this other crucial piece. Getting wealthy and staying wealthy. Apparently, those are two different skills entirely.
Oh, absolutely. This is such a key point. Think about what it often takes to accumulate wealth, especially starting from scratch.
Right, you might need some optimism, maybe you take some calculated risks.
Exactly.
Yeah.
Seizing opportunities, maybe being a bit bold, but preserving wealth. That often requires a totally different mindset.
Like what?
Humility, for one, an awareness that things can go wrong, that you can lose what you've gained. And often it requires a certain amount of discipline Frugality even, not letting lifestyle creep get out of control.
Yeah, we see this play out all the time, don't we? You hear stories about lottery winners or athletes who get huge contracts.
Sudden wealth.
And sadly, a lot of them end up broke
Yeah.
just a few years later. They got the wealth part.
But they didn't have the stay wealthy skills. They lacked that mindset, maybe the discipline to protect what they had. So it seems like you need both eventually. You need the courage, maybe, to take those smart risks to build something, but also the wisdom, the humility to know when you have enough and to shift focus towards protecting it. It's a balance.
That word enough,
Yeah.
that leads perfectly into the next idea, doesn't it? This concept of defining enough.
Yes. It sounds so simple, but it's incredibly powerful and maybe incredibly difficult in today's world.
Why is that?
Well, think about it. We're just constantly bombarded with messages telling us we need more. The bigger house, the faster car, the newer
The
phone.
goalposts keep moving?
Exactly. It's this hedonic treadmill idea. You earn more, so you spend more. And your baseline level of happiness or satisfaction doesn't really change much. You just need more to feel okay.
So you're always chasing.
You're always chasing. It's a cycle that's hard to break.
The source material uses this great contrast, right? There's the super successful hedge fund guy.
Yeah, flying high.
But he keeps pushing, taking bigger risks, wanting more and more, and eventually it all comes crashing down.
Right. Versus the classic story of the unassuming janitor or secretary, someone earning a modest income, who just diligently saves and invests a small amount consistently over decades, and they end up retiring a quiet millionaire.
It's incredible. It really shows that wealth isn't just about the size of your paycheck.
Not primarily, no. It's so much more about your behavior, your savings rate, and crucially, your ability to define what enough actually means for you.
Before life or the market defines it for you, maybe in a vengeful way.
Precisely. Without that personal definition, that ability to say, okay, this is good, this is enough, the pursuit of more can just become this endless and ultimately unfulfilling trap.
Okay, that's a heavy one. Let's shift to something maybe a bit more about uncertainty. Beware of tail events. They define everything. What are tail events?
Tail events are those things out on the edges of the probability curve. The really rare, really extreme occurrences, but the ones that have a massive disproportionate impact when they do happen.
So not the everyday ups and downs.
No, not the average stuff. Think the 2008 financial crisis, or the dot-com bust, or maybe on the positive side, finding that one investment that goes up 100x.
Right. The source mentions Buffett again here, right? That a tiny fraction of his investments drove the vast majority of his total return.
Exactly. Like maybe 1% of his decisions or investments accounted for, 90% of the outcome. Same thing in venture capital. They expect most startups to fail. They're banking on one or two massive successes, those positive tail events, to carry the whole portfolio.
And it's not just finance, is it? It can happen in life, too.
Oh, absolutely. A sudden, unexpected job loss, a major health diagnosis. These are tail events on a personal level that can completely change your financial trajectory.
So what's the actionable insight here? We can't predict these things.
No, you can't predict them precisely, but you have to respect their possibility. The idea is you plan for the average, you make decisions based on what's likely, but you always have to keep in the back of your mind the potential for the extreme outlier. This means building in some margin of safety, having buffers, keeping some dry powder or savings.
And crucially, avoiding decisions that could completely wipe you out if a negative tail event occurs, even if the odds seem tiny.
That's the big one. Avoid ruin, because one single black swan event, as they call them, can undo decades of hard work if you're positioned too aggressively or without any safety net.
Okay, margin of safety, respect the outliers. Got it.
Now, here's one I really like, a perspective shift. Saving is freedom, not sacrifice.
Yes. This reframes the whole idea of saving, doesn't it?
Totally. I think most people think of saving as, delaying gratification, giving up something fun now for something later. Sacrifice.
Right, the conventional view. Foregoing the fancy dinner now so you can, I don't know, buy a slightly bigger TV in 5 years or whatever.
Yeah. But this perspective says saving isn't primarily about future consumption. It's about gaining control over your time. Exactly. The highest dividend money pays is control over your time. That's a powerful quote.
How did that work practically?
Well, think about it. Every dollar you save that you don't need to spend right now, it's buying you a little piece of future flexibility, future options.
Options like?
Like the option to leave a job you hate, even if you don't have another one lined up immediately. The option to take time off to care for a sick family member. The option to handle an unexpected expense without going into panic mode or debt.
The ability to say no sometimes.
Yes, the ability to say no to obligations you don't want, or yes to opportunities that might not pay well initially but could be amazing long term. It gives you breathing room.
So it's not just delaying pleasure, it's actually purchasing autonomy, freedom.
That's the core idea. Each saved dollar represents future peace of mind, more choices, less stress, more control over how you spend your days. It's buying back your time, buying freedom, not just postponing a purchase.
I like that frame a lot. Okay, last main point, and it feels like a good one to wrap the core ideas. You're playing a game with invisible rules.
Mm-hmm. This brings a dose of humility, I think, and maybe some relief from comparison.
Oh,
It's just recognizing that everyone,
yeah.
everyone is operating with different goals, different time horizons, different risk tolerances, different backgrounds, different unseen circumstances.
Right. You see someone online bragging about doubling their money on some risky bet,
Yeah, the day trader killing it, supposedly.
or your friend is pushing you to get in the same hot stock they're in, or you feel bad because your neighbor seems to be saving way more than you.
All that external noise. But the reality is you have absolutely no idea what their full financial picture looks like.
You don't see their debts, maybe their family obligations, their actual long-term plan, or lack thereof.
Exactly. You don't know what game they're actually playing. They have their own set of rules, often invisible to you.
You know.
Then you have yours.
So the liberating part is stop trying to play their game.
Yes. Define your own game. What are your goals? What does financial success look like for you? Is it retiring at 55? Is it having enough flexibility to spend more time with your kids now? Is it building a business?
Get clear on your own why.
Precisely. Once you know your own objectives, your own time horizon, your own risk tolerance, you can start filtering out all that noise. You can focus on the strategies and behaviors that actually align with your definition of winning. Ignore the Joneses, basically.
Because they're playing a different sport altogether, maybe.
Could be.
Okay, so bringing this all home, if we had to boil it down, the big overarching message really seems to be that wealth, financial success, it's way more about psychology than finance theory.
Absolutely. It just hammers that home and again.
Yeah.
It's less about how smart you are or how much you know about discounted cash flow analysis,
Right.
and much, much more about how you behave, your temperament, your ability to manage your own emotions, your biases, your relationship with time and risk.
That's the core truth, isn't it? You could be a financial genius on paper.
Yeah, know all the theories.
But if you panic sell in every downturn, or you can't control your spending, or you're constantly chasing the next hot thing because of FOMO,
Then all that knowledge isn't going to do you much good in the long run. Mastering your behavior seems crucial, regardless of your income level or how many finance books you've read.
Okay, so let's try to nail down 3 quick takeaways for everyone listening. What are the absolute essentials?
All right, rapid fire. 1, time beats timing. Get started, even small, and stay consistent. Let compounding work for you.
Okay, time beats timing. 2,
2, maybe save like a pessimist, invest like an optimist, meaning build that safety buffer because unexpected things happen, but have faith in long-term growth when you invest.
save like a pessimist, invest like an optimist. I like that. And 3,
3, know you're enough. Seriously, define it, write it down. Without it, wealth just becomes a hamster wheel.
okay, great takeaways. Now, for the challenge, one thing people can do today.
Right. So here's a question to ask yourself, maybe later today, quietly. What would money really mean to me? What would I do with it if absolutely no one else could see how I earned it or spent it?
Ooh, that cuts through the external pressures.
Yeah, try to get to the core of what you value, and then take one small concrete action, just one.
Like what?
Could be anything. Maybe automate a tiny transfer, like $20 a month, to a savings or investment account. Just get it started.
Right.
Or maybe take 5 minutes with the notebook and just jot down some initial thoughts on what enough might actually look like for you. No pressure, just start thinking.
Or maybe even just unfollow one social media account that consistently makes you feel inadequate or triggers that comparison anxiety.
That's a great one too. Anything that takes a small step towards applying these ideas.
Perfect. That's a powerful challenge. So as you go about your day, maybe just reflect a little on those unseen stories, right? Your own biases, your own history with money, and think about cultivating that deeper understanding. Your personal relationship with money really does go far beyond just the numbers on a screen.
It really does. It's the human element that matters most.